Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter Cheviot. I'm Ollie Creasey, Property Research Analyst here in the London office, and I'm joined on this autumn morning by hardy perennial of the podcast, Richard Carter, also known as Head of Fixed Income, and I can also welcome special guest, Mamta Valechha, our Consumer Discretionary Analyst. Good morning to you both. Richard, turning to you first. A busy week last week, at least that's how it feels, and there's plenty to talk about, so we're going to have to slightly cherry pick our topics here. I do think we need to talk about the developments in the Middle East conflict, and a number of headlines suggesting stock market weakness as fears of further escalation over there grows. How much of this do you think is oil price related, and is there maybe some wider issues at hand here?
Well, I think when you hear the sort of you read the headlines about Israel potential attacks on Iran and all the sort of things that have been going on over the last year, and let's not forget it's now 1 year has passed since the Hamas attacks on Israel. I mean, I think markets are always going to be a little bit jittery about that, and risk aversion is bound to come through. But I do think oil is the one I think that really gets people's attention, not because obviously Israel and Lebanon has a particular angle on the oil price or oil production, but it's clearly the Iran angle, and at the moment the risk of a Israeli retaliation against Iran following the recent missile attack, and who knows what form that might take. And the danger is that the Israelis decide to attack Iran's oil facilities, very important producer, sends a lot of its oil to China. So you wouldn't, it's understandable that markets are a little bit jittery on that front. And clearly, higher oil price means higher inflation, means less chances of interest rate cuts. So there's that dynamic as well. And you can see by the performance of certain sectors, in the UK, oil sector doing pretty well versus other areas that I think, as I say, that the main transmission mechanism is the oil price.
Thanks, Richard. Yeah, maybe we'll move to the US now, where we've seen some slightly mixed employment stats. We've got the JOLTS, jobless claims. You may have to tell everyone what JOLTS stands for, by the way. And non-farm payrolls, which I think we can understand. Some of these pointing to a slowdown, others not quite so much. Out of all of these, what's the most important data point for you? And I suppose what more importantly, what impact is it all having?
Well, I think you've got to not just look at one data point and take a variety of them over a period of time, including surveys and some of the PMIs and things like that. Payrolls is a bit more recent than JOLTS. The JOLTS is the job openings report, and they're giving conflicting messages, and also things like payrolls can be revised away. You have sort of seasonal distortions in the numbers and all various things. So you do have to sort of take the big picture and not just obsess really with sort of one particular data point. But I'm afraid markets can sometimes do that. I'd say the overall picture is a little bit mixed, but the latest payrolls numbers we got last Friday suggest that there's not really a big slowdown happening in the US labour market. Certainly worries about a recession are probably a little bit over the top. So what does it all mean? I mean, the implication really goes back to central banks. What's the Fed going to do in terms of rate cuts and all the rest of it? And how worried would they be about a slowing of the US labour market? Assuming that sort of strong payrolls numbers continue, there's no chance of another 50 basis point rate cut by year end. So those expectations were sort of reversed in the last week, and it now looks like there'll be a couple of 25 basis point cuts by year end by the Fed, which makes sense. So rates are coming down, but it's going to be a gradual pace.
Interesting, thank you. Now, maybe final question for now, Richard. I'm aware you discussed the recent stimulus in China last week with my colleague Jack, so I don't propose to go into too much detail on that again. However, we should note that there's an interesting quirk to this situation whereby the Chinese stock market has actually been closed most of last week following the stimulus announcement. Do you think that means we haven't yet seen the full impact? And what can we expect when that market reopens this week?
Well, we'll find out pretty soon. I mean, I think there's been a massive, massive move in the market anyway, so there could be more to go. But there was clearly a bit of a buying frenzy. Perhaps that was, accelerated by the fact that everyone knew a holiday was imminent, so that led to a sort of massive squeeze upwards, and we've gone from a sort of bear market to a bull market in the blink of an eyelid. So yes, there might be a little bit further to go, or perhaps some of the frenzy will have died down in the intervening week. And let's not forget, there's other things going on in the world that may be less encouraging to investors. We've also had, Hong Kong markets have been open during the holiday, or mostly been open during the holiday. They've done well. They've done very well too, although the sort of big upward move has sort of died down a little bit. So I think probably we've seen the most of it now. But clearly, what the Chinese government's doing is quite a big stimulus. So there might be a few more investors looking to. The fear of missing out, they might be looking to get into the market as this week goes on.
Thanks, Richard. That's really helpful. I'm going to turn to Mamta now, I think her past week hasn't been any less eventful by the look of things. Welcome back to the pod. I wanted to talk first about Nike's Q1 update, which certainly seemed to cut through the geopolitical noise, but not necessarily for the right reasons. Could you give us a quick summary on what was announced by the company?
Hi, Ollie. So Nike, who reports off cycle, announced their first quarter 2025 results last week, and as expected, they were very weak. Revenues were down 9%, with half of this impact due to Nike trying to cut stale SKUs across the key franchises, and the other half due to soft demand. But Nike was able to pull through strong gross margin due to one-off benefits, and as a result, earnings were better than feared. However, these results ended up being irrelevant. So, after a weak initial financial year 2025 guide in March, which was then cut in June, guidance for the full year has now been entirely pulled. Going forward, management will guide quarter by quarter, starting with a cut to Q2 guide, where revenues are now expected to be down 8 to 10%. Gross margin was also guided to be down year on year, mainly due to higher promotions in the market and severe cuts in Nike's own digital channel, which is the highest margin channel. Additionally, Nike's Investor Day, which was planned for November, has also been postponed indefinitely. Now, we expect these actions will leave the stock in limbo until we hear from Elliot Hill, who returns to Nike as the new CEO in mid-October and provides his vision.
Wow. So that's sounds like things are going pretty wrong at Nike then. I have to. That surprises me. I think of them as a sort of market leader in sports clothing, and maybe they still are. So do correct me if I'm wrong there. But I'm curious to know what you see as the kind of root causes of all of these problems.
Yeah, so lack of innovation has been the sweeping statement behind Nike's slowdown. But like you questioned, Ollie, how did a company like Nike fail at innovation? And we have identified three organizational issues that led to Nike running off course. Firstly, the design process became too complex. So the process to create and launch new products, at least at Nike, takes 2 to 2.5 years, which means a product hitting the market for this autumn-winter season, the inception started at the start of 2022. Now, this is understandable for new performance innovations. However, even when an iteration of an existing franchise was being launched, the process took a year. Secondly, the production creation process was made even more complicated when in 2020, Nike shifted its focus from product to a gender based structure. So instead of having designers focused on a product category such as running or basketball, tennis, it shifted to men's, women's, and kids with individual categories layered underneath. So this means you'll have women's basketball separated from men's basketball. And then you have reviews to ensure no overlaps or inconsistencies. So just imagine the complexity. Now, having a lengthy product development process is sort of still okay once you can anticipate what is cool before the consumer knows it. And this requires constant trend monitoring and consumer insights, Which brings us to the third issue. Nike removed the feedback loops they had in key markets. This was partially due to a cost-cutting exercise they went through in 2021, but also due to an over-exuberance about the data Nike would gather from the aggressive shift to their own e-commerce channel. Now, cutting ties from retailers meant that while Nike knew what Nike members were buying on their website, they lost data on which competitor products were doing well, which ones were being selected over Nike, and why.
Wow, so there's a few issues ongoing there by the sound of things. I take it it's not quite so simple as stop doing those things to turn this around. What do you think the Nike execs, and I suppose that new CEO who's on his way, are going to have to do to win back the confidence of investors?
Yeah, great question. So one of the criticisms the outgoing CEO of Nike has faced was that he was not from the industry and didn't have the expertise in product. So the announcement of Elliot Hill as the new CEO was the first catalyst for change. He spent 32 years at Nike until his retirement in 2020. Now, a product-focused leader is a necessary but not sufficient condition for success. There is much that still needs to change at Nike, including making a slow design process more nimble, reinstating feedback loops to understand changing consumer tastes, clearing out stale products to make room for new innovation. China is also no longer a growth engine, and smaller players such as On and Hoka have eaten up Nike's market share. Now, Nike's CFO on the last call last week said it best: a comeback at this scale takes time. So while innovation is coming, it takes a while to scale a product. So we do not anticipate any major impact until the second half of 2025.
Interesting, thanks. Now, obviously, Nike's a US stock, but we do own JD Sports here in the UK, which I guess it's fair to call an adjacent brand in the consumer apparel space. Has JD taken a kicking as a result of Nike's weakness, or is it a slightly different story?
Yes, JD Sports actually had their second half results the morning after Nike's. And in short, they were pretty strong, organic growth up 6%. And in what is still a relatively promotional environment, gross margin were only down by 10 basis points. The group also reiterated guidance. However, the stock was down 6%, partially on the back of Nike's depressed news. We think fears over Nike are overdone. The market is underappreciating the rising importance of other brands such as Adidas, Hoka, and New Balance for JD Sports, and its agility to capture trends. Also, product newness is also crucial when capturing consumer demand. So, where consumers are not getting newness and innovation from Nike, they are simply going elsewhere. And this is pretty much a strength of being a multi brand retailer like JD Sports, whose own brand also gives it access to exclusive and high heat products.
All right, thank you. That's very interesting. So I'll finish off with I'm not sure this is a light-hearted question, to be honest, but a low consequence question for the time being, anyway. We've had the US vice president debate last week. We're about a month away now from the US presidential election, and it seems like everything's on a knife edge, to be honest with you. Maybe that debate pushed things ever so slightly back in favor of Donald Trump and JD Vance. But look, for anyone who wishes to comment, I'm curious, does anyone feel brave enough to make a prediction at this point, or is it still too close to call?
I mean, from my point, Ollie, no, I don't, to be honest. And I had hoped, not giving away my own political biases here at all, but I had hoped that the momentum for Kamala Harris was sort of pretty good, and the gap was widening, and could relax a little bit that she was likely to win. But that seems to have, as you say, slightly reversed. And just looking at the betting odds this morning, they do seem to be neck and neck. So, yeah, we'll have to wait and see. Another month to go. A lot could happen. I do think, from an investment point of view, markets seem to have forgotten about it as a bit of an issue in some ways, and certainly the bond market, where you would worry that a Trump victory would not be great for certainly US Treasuries because there's likely tax cuts and all the rest of it. They do seem to have, had their markets seem to have had the focus elsewhere, which I guess is understandable, but I suspect that will change over the next 3 to 4 weeks. So too close to call, but bond markets would certainly prefer a Harris victory, I think.
Yeah, thanks, Richard. I think given your importance to the podcast, I don't think we can sanction you for taking a political stance in this instance. So look, I think we should leave it there. Thank you both very much for those insights, and we've covered a range of topics today. Before we completely come to a close, just a reminder for the listener that if you do have questions that you'd like to ask one of our analysts, we can put that question forward via a submission on the weekly comments page of our website. And we do genuinely love to hear from you. I've said this before, but the questions do make their way onto the podcast from time to time. So do please keep submitting them. And of course, do please stay up to date with our thoughts on markets and current issues. You can find them all at our website, quiltachieveit.com. And you can also see more of what we're doing here, as well as watching past webinars on demand. And of course, subscribe to the weekly comment newsletter. We'll be back as usual next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on Facebook, Instagram, Twitter, and of course, LinkedIn. So just for me to say now, thanks again to Richard and Mamta for your time today, and of course to all of you for listening. Thank you and goodbye.